I'm Nolan.
I'm Leah.
And we are with the Tailored Realty team. And today we are doing a gripping installment of Tailored Tuesday, all about down payments. So we're going to be talking everything. We're going to be talking everything that you need to know or ever wanted to know about down payments. So Leah, take it away. What is a down payment?
A down payment is a portion of a loan that you pay when you buy a house. You put down a certain amount of money up front, and this goes towards the total cost of your home for a loan. So you pay a certain percentage of that cost, and then the rest of it is covered in your mortgage. The rate for your mortgage and the mortgage insurance you pay always improve the more your credit improves, and the higher down payment that you put down. So if you're putting that 20% down that a lot of people expect to put down, then you're building higher equity in your home, and you're also lowering your monthly payment on your mortgage. So now that we understand what a down payment is, before we hop into any of the how much did I put down information, Nolan, can you tell us a little bit about the different types of loans?
Yeah, so the amount you're putting down is going to vary based on what type of loan you're taking out. And there are several different types of loans available to people looking to purchase a home. We're going to cover kind of the main four that we typically see. So the first being conventional. A conventional loan is the most common type of loan that we see for the most part. A conventional loan is advantageous for someone who maybe has a little bit of a higher credit score and a lower debt-to-income ratio. Typically you see people going with a conventional loan if they have a little bit more money to put down. And that can be anywhere from like 3 to 20%, which we'll get into a little bit later. And a conventional loan you can get taken out at pretty much any financial institution, any bank or private lender. The second type is an FHA loan. FHA loans are government-backed loans. So there's a little few more hoops to jump through in order to get an FHA loan. And with FHA loans, they require a little bit different of an appraisal process, and not all homes are FHA approvable. So that's something that you can definitely get into with your realtor if you're looking for a home and you are FHA approved. There are plenty of options out there for people who are on FHA loans.
Absolutely.
And FHA loans are great because they're really advantageous for people who maybe have a little bit lower of a credit score and a little bit higher debt-to-income ratio. So if you can't always qualify for a conventional loan, you very well may be able to qualify for an FHA loan. There's just a few more hoops you have to jump through in the purchasing process if that's the case. The third type is a VA loan. So this is a great choice for U.S. military veterans or active duty service members. With that, you have to just get an approved certificate of eligibility to prove that you are eligible for a VA loan. And these can be really useful, especially for veterans or active service members who have a lower credit score or higher debt-to-income ratio and don't have the money to put down right away. This is a program that was created for that. And the fourth is a USDA loan, which is like a rural development loan. So these are special mortgages for low to moderate income buyers, specifically in rural areas. And we can get into that a little bit more. So those are the four major type of loans that we see. Typically everything we're dealing with here in the Twin Cities market, where we don't have a lot of USDA approvable space, is going to be either conventional, FHA, and the occasional VA. So now that we've talked about those types of loans, Leah, how much money do you need to put down for all of these loans?
Yeah, so it definitely varies, and it really depends on your situation, what you want to do, and it's always good to have a conversation with your lender about it. But as far as the minimums about what you need to put down, if you're doing a conventional loan, typically you need a minimum of 3%. That can change, but typically it's only a minimum of 3% if you are a first-time home buyer or a repeat buyer that meets certain income limitations, there we go. And otherwise it might be somewhere around 5% minimum, but somewhere in that 3 to 5% range typically. And then also, like Nolan mentioned, going up to that 20% or really whatever it is that you want to put down. FHA, the minimum is 3.5%, so typically, like Nolan said, it's better for buyers who might have lower credit score, higher debt to income ratio. So in those cases, they're typically going to stick around that 3.5% as much as they can. And for a VA loan, if you're a veteran or an active duty service member, then you have a 0% minimum. You don't need a whole lot of cash to go to closing, and it's really advantageous for somebody who qualifies for that. And then same for the rural development loan, the USDA loan, that's a 0% minimum as well. So there are options that you can really work with
Yeah.
depending on your financial situation.
Really great options.
Yeah. So, Nolan, I never mentioned much about the 20%.
Mhm.
It seems like there's a lot more options than that out there. So where does this 20% come from, and when would people be putting down that 20%?
Yeah, so for a very long time, the standard was that 20% down, especially with a conventional loan. And we see a lot of people, especially first-time home buyers, saying, oh, well, I don't have 20% down, so I can't afford to buy a house.
Mm-hmm.
And while that was long kind of thought of as like the standard, that isn't necessarily true anymore. You know, we see more and more first-time home buyers, even people who qualify for a conventional loan, still only putting down that 3 to 5%.
Mm-hmm.
So a 20% down payment can be great. It can be very advantageous, especially if you find yourself in a very competitive market like we are now, and you're in a multiple offer situation. The more money you're putting down, the stronger of an offer you have, and the more equity you're going to be able to build right away in that home.
Mm-hmm.
But that doesn't mean it's always necessary. In fact, we find many of our buyers right now are finding a lot of success in getting accepted offers, either with an FHA loan at 3.5% down,
Mm-hmm.
or with the conventional loan at 3% down or 5% down. You know, you don't always need that 20% down anymore. And part of what that is, you know, there was always this push to always put down 20% so you could avoid PMI. And we can get into that a little bit more, but that's not always necessary anymore. You can put down 3% on a conventional loan and pay your PMI until you reach 20%. So, a lot of options.
Mm-hmm.
So, I've talked a little bit about PMI. Leah, what is PMI?
Yeah, PMI is private mortgage insurance. So typically that's a monthly fee that's rolled into your monthly mortgage payment, paid all at once, which is basically to protect the lender. So when you put down less than 20% on your loan, that's a riskier loan for them to lend to you. So in those cases, they want to make sure that they're protected in case you stop being able to pay your loan. So until you reach that 20% mark of equity, they're gonna charge you that monthly fee, which PMI is typically between $30 to $70 per month extra on your mortgage per $100,000 borrowed in your financing. So this is separate from homeowners insurance. It's not the same thing. Homeowners insurance is more so to protect your home and all that, but this PMI will make your monthly mortgage payment higher, like I said, and the less money that you put down on your mortgage or on your loan will also be raising your monthly mortgage payment. So that's just something to consider, that the less money that you put down, the more likely you're going to have that PMI, and then the higher mortgage payments. So it does make your mortgage payments higher the less money that you put in. But where PMI is really useful, or the cause of it is really useful, I guess, is that it allows you to buy a home when you're not quite in that 20% savings place, where you haven't been able to save up 20% to buy a house, and you would normally have to wait, 5 to 10 years before you save up something like that. You can get in a house now versus way later, so it's really awesome in that case.
Yeah, and on the subject of PMI loans, one other thing to note is that yes, you do have to pay that until you hit that 20%, and that's on a conventional loan. On an FHA loan, you're going to pay that PMI throughout the life of your loan. Just because it is a government-backed loan, and so the government, where it's a government-backed loan, they still need that insurance on the loan that you're not going to default and that their loan is protected.
Yeah. Awesome.
Yeah, so that's kind of everything we were going to hit for specifics about, loan types, how much down payment you need for each, what is PMI, what is a down payment. And now we're going to just go into a couple frequently asked questions about loans and down payments. And certainly if you have any questions, leave a comment below. We'll try to get to those. But otherwise, I'll start. We've got some prepared here. So first, Leah, can a seller contribute to your down payment?
Good question. The seller cannot contribute to your down payment, and neither can your lender. You have to come up with the down payment yourself. But the seller can contribute to your closing costs up to a certain amount of it. So that's definitely an option, and it varies with the type of loan that you get as well.
Gotcha.
So Nolan, if I wanted to pull money out of my 401k or any stocks that I have, could I do that to get my down payment money?
Yeah, you can. So if you have a healthy 401k or you have some stocks, you certainly can pull money out of those to contribute to your down payment. However, if that is the case, we suggest you proceed with caution because it can be kind of risky. And you may also have like early withdrawal fees. There may be special taxes that you're going to have to pay depending on where you're pulling your money from. So that's a conversation to have with your financial planner or whoever does your taxes, or if you have someone who does that kind of work for you, have that conversation with them. Find out, are there going to be any penalties if I pull money from these accounts in order to do this? And if I do so, am I going to have, enough money left over? Is it the right move for me, or should I work on just saving money separately from your 401k and your stocks?
Mm-hmm.
Leah, can I use a cash gift as a down payment if I don't have the money myself?
You might be able to do that. You can use a cash gift for a down payment, especially if you're doing or you're buying your first home. But it must come from a relative, and even some relatives it doesn't count. I think like cousins you can't get a down payment gift from, but you can from like a parent or a grandparent or even an aunt or an uncle. But another thing to watch out for is if you are buying a second home, you at least need to have 5% of the down payment of your own money. And if you are investing in an investment property, then you will need to put 100% of your own money into the down payment. So it's possible that you could use a gifted money as your down payment, but obviously be aware of the rules around that too.
Right, gotcha.
Which is typically the answer. And like Nolan said, you're always going to want to talk to a lender about your situation. There's always variations, so always ask. But Nolan, final question from our FAQs. How does an appraisal affect your down payment?
Good question. So an appraisal is something that's going to be ordered by your lender once you purchase a home and once your purchase agreement is accepted. Your lender has time to come do an appraisal on your property, and that's going to determine the value of your property that they are going to be giving you a loan for. So let's say you're putting down 20% on a home and you offered $300,000 in your purchase agreement, and that was accepted, but then an appraisal comes in and the appraiser says, oh, the home is only worth $270,000 instead of $300,000. Well, in that case, your loan officer, your lender, is only approving you for a loan on that $270,000, and your 20% down payment is on that $270,000. It's not on $300,000. So you have that 20% down on $270,000, but then if the seller isn't willing to negotiate, which is often the case, or sometimes you need to work something else out, you might be on the hook to pay that difference because you've already signed a contract with the seller to buy the home for $300,000. So you may find yourself, putting a 20% down payment on the $270,000 and then needing to come up with the additional $30,000 to pay the seller at closing. So that's something to think about if you're planning to offer, way over the asking price of a home. Think about what that home is going to appraise for. It's not always in your best interest to offer way more than a home is worth unless you have the cash to be able to make that up in a difference in the down payment from the appraisal.
That makes sense.
Yeah, which is kind of a convoluted answer. There's a lot going on there. But yeah, an appraisal can definitely affect not necessarily your down payment, but how much money you need to bring to closing. Because your down payment is going to be based on the appraisal, but you might need to bring extra money to closing to make up the difference from the appraisal to your purchase price.
Which leads us to a really great point, which is the down payment is not your only cost at closing. There's other fees and things that you will usually need to pay for. And we'll cover those eventually on another Taylor Tuesday.
Right.
So TBD, always tune in because we've got great information. But this just covers the down payments information. So
yeah, so today we talked all about down payments. Leah told us, what a down payment is. It's the amount of money that you're putting down as I don't know how to explain a down payment without using the upfront cost of your loan. There you go. And we talked about the different types of loans, conventional, FHA, VA, USDA, and the different percentages of down payments required for each. And yeah, some frequently asked questions.
And some PMI.
And some PMI, don't forget the PMI.
Never forget.
So if you have more questions, certainly write those in the comments below. We'll be responding to questions and answering everything, throughout the week. And make sure you tune in next Tuesday. For another gripping installment of Taylor Tuesday.
Always.
And we hope to see you this Friday at our drive-in movie event.
Yeah, go RSVP. It's going to be a lot of fun.
It's going to be a lot of fun. Awesome. Well, Thank you all for tuning in, and we will see you next week.
Bye, guys.